The first time I lost 5 trades in a row, I went straight back to the backtest. I checked the rules, I looked at the data, I looked at my account, but nothing in the system had changed. Nothing in the market was broken. The system was doing exactly what the rules said it should do. I was convinced that something was wrong. I almost turned the strategy off that week. 2 more trades, both losses, would have made me do it. That was nearly 6 years ago. And the thing that stopped me from turning off a perfectly functional system wasn't experience, because I didn't have any. It was that someone showed me the math. The actual probability theory says that losing 5 trades in a row is statistically normal for a system with a 60% win rate, and that turning off a system inside of its own statistical drawdown is how most retail investors guarantee they lose money. In this video, I'm going to walk you through 5 concepts from probability theory that, taken together, are the difference between being a trader who survives and a trader who quits before their system works. I'm going to use my own systematic portfolio as an example throughout. 5 live strategies running real capital, but the maths applies equally to any trading or investment approach, whereby the outcome of a single trade is uncertain. If you've ever turned off a system during a drawdown and then watched it recover without you, this is probably the video you needed to watch. So let's start with the most basic concept, and that's one most retail traders never properly internalize, and it's called expectancy. And it's the only number that tells you whether the system makes money. Expectancy is the average amount you should expect to make per trade across a large sample of trades. It depends on 2 things, and the only 2 things are the win rate and the risk to reward ratio. And here's how it works in the simplest case. Imagine a system with a 50% win rate. Every time it loses, you lose $1. Every time it wins, you make $2. That's a 50% win rate and a 2-to-1 risk-reward ratio. The maths says that over 100 trades, you should make about $50. Half of the time you lose $1, that's a negative 50. Half of the time you win 2, and that's a positive 100. So the net effect is positive 50. That's a profitable system. Not because it wins more than it loses, it doesn't. It wins only half of the time. But because when it wins more than when it loses. Now, most retail traders don't have a system this clean. Most systems have variable risk reward, variable win rates, and a stack of hidden costs that spreadsheets don't forecast. That's slippage, commission, tax, and these things really matter. A system that's marginally profitable on paper can be unprofitable in real money once slippage and tax comes into play. But the underlying principle still holds. Expectancy is the win rate times the size of your wins minus your loss rate times the size of your losses. And if that number is positive after costs, then the system makes money over time. But if it's negative, no amount of clever trading psychology will save it. I run 5 different systematic strategies and they sit at very different points on this curve. My mean reversion system has a 60+% win rate, but rarely takes more than 90 cents on the dollar. My momentum systems have a 40-something% win rate and take 1.5 to 2 times what they risk. Both are profitable. Both fit on the same fundamental expectancy equation. That brings us to the second concept, and there's a relationship in trading that nobody explains clearly, and that is win rate and risk reward are inversely correlated. If you want high win rates, you have to accept a low risk to reward ratio. If you want a high risk to reward ratio, you have to accept a low win rate. You don't get both. And that's not a strategy choice, it's a structural property of the markets. Now there's a chart which I'm showing on screen that shows this curve clearly. Below about a 20% win rate, you're hunting for risk reward ratios of 5 to 1 or higher. And above 70%, you're typically working with risk reward ratios well below 1 to 1. In the middle of the curve, between 40 and 60% win rates, sits at risk rewards roughly between 1 to 1 and 2 to 1. That's where most viable systems live. And here's the part that breaks people. At any point in that curve, there's a minimum win rate below which the system loses money no matter how disciplined you are. At a 2 to 1 risk reward ratio, the minimum is 33%. Below 33% you're losing, above 33% you're winning, and there's no skill involved, it's just arithmetic. And this is why retail traders chasing high win rates are setting themselves up to lose. A system that wins 70% of the time looks comfortable, but it's only profitable if your wins are roughly the same size as your losses, which means tight stops, tight targets, and tight stops mean the small amount of noise in markets knocks you out. The system feels safe, but but it's mathematically fragile. Conversely, a system with a 40% win rate looks brutal. But if your wins are twice the size of your losses, you're profitable with serious room to spare. But the psychology is harder, the maths is easier. So this brings us to the third concept, and it's one most retail traders never plan for. Losing streaks are not a risk in trading, they're a certainty. Here's the math. Even with a 90% win rate, which, to be clear, no actual trading system has, over 1,000 trades you can statistically expect to see 3 consecutive losses at some point. And that's astronomically lucky, but not impossible. Now, if you drop your win rate to 60%, which is genuinely high for systematic trading, the math says that over 1,000 trades you should expect to see 8 consecutive losses. Not might see, should see. The probability theory says it's coming. At 40%, which is normal for classic trend following systems, that number jumps to about 12 consecutive losses. Most retail traders quit anywhere between their 3rd and 5th consecutive losing trade. They look at the streak, decide the system has stopped working, and they either turn it off or they tweak it, which is the same thing in slow motion. Both of those reactions are how good systems get destroyed. I run a mean reversion strategy in the Australian markets that, at the time of recording, has not taken a single trade in weeks. The signals haven't fired, the rules haven't seen anything that meets the entry criteria, and from the outside it can look like the system is broken, but from the inside the system is doing exactly what the rules are designed to do. This connects directly to position sizing. If you're risking say 2% per trade and your system has a 40% win rate, you should expect at some point to be down 24%. That's the 12 trade losing streak hitting you at full position size. If a 24% drawdown isn't survivable for you psychologically or financially, then the 2% per trade is the wrong number. The position size isn't a separate decision from the system, it's part of the system itself. You size your position so that the statistically inevitable losing streak is something that you can survive without intervening. So concept 4 is the gambler's fallacy, and this is probably the single most expensive psychological trap in trading. The gambler's fallacy is the belief that past random events influence the probability of future events. It's the feeling, and I'm using the word feeling deliberately, that after losing 5 trades in a row, you're due for a win. After winning 5 trades in a row, that you should take some off the table because you're due for a loss. You're not due, and the market doesn't owe you. Every trade is independent of the trades before it. The clearest example of this isn't from trading at all. It's from the roulette table at the Monte Carlo Casino in 1913. The wheel landed on black 26 times in a row. The odds of that happening were about 10,000ths of 1%. Gamblers lost millions betting on red because they believed red was due. The probability of black on any individual spin was still 48.6%. It didn't go up just because red hadn't come up recently. The wheel had no memory. The markets don't have memory either. Your next trade has whatever probability of winning your system gives it, independent of whether your last trade won or lost. The temptation to add risk after winning streaks, or pull back after a losing streak, or wait for confirmation after a few weeks of underperformance, all of these are expressions of the gambler's fallacy. None of them survive a backtest. And this is, in my experience, the single biggest reason I'm a systematic trader and not a discretionary one. When I traded on my own judgment, I was a walking gambler's fallacy. I took profit too early after winners because I felt like the rally couldn't continue. I held losers because I felt like it had to bounce. The outcomes were no better than flipping a coin, except flipping a coin is free. And in every decision I made on a feeling came with a transaction cost, slippage and tax. I was paying real money to get a random result. So how do you actually use all of this? 5 real applications and then we'll close. So first, calculate your system's expectancy on paper before you trade real money. So the win rate, the average win size, the average loss size, and the cost stack in its entirety. Slippage, tax, commission. If the number isn't positive after costs, no execution skill in the world will save you. Second, accept that your win rate determines what kind of psychology you need. If your system is a 40% trend follower, you're going to be wrong more often than you're right. And the only way you can make that comfortable is to fully understand and internalize why being wrong more often is fine. And if your system is a 60% mean reversion strategy, you're going to be right more often, but your wins will be smaller and your losses will sometimes feel disproportionately painful. The third, run the losing streak maths for your actual win rate over a realistic sample size. Then size your position so that that streak, when it comes, is something that you can survive and live with. I personally aim to size position so that even a worst case statistical streak keeps me below a 25% portfolio drawdown. And that's even higher than I'd recommend for most people, especially if you're closer to retirement, but it works fine for me. And this fourth one is really important. Run more than one uncorrelated system at once. The losing streak maths gets dramatically kinder when you have multiple strategies firing on different signals at different times. I run 5 independent systems precisely because their drawdowns don't happen all at the same time. So when my mean reversion is in a statistical drawdown, my momentum is actually working. The portfolio isn't betting on a single system being right at any given moment. It's betting on the maths averaging out across all of them. And fifth, and this is a hard one, when the losing streak hits, and it will, trust the maths, not your feeling. The feeling that the system is broken is the feeling that every trader has had at the moment that they were about to give up on a perfectly functional strategy. The math doesn't change because you've had a bad week. Your job isn't to continually decide if the system still works. Your job is to execute the strategy and system flawlessly long enough for the probabilities to play out. The real edge in trading isn't a high win rate. It isn't a better entry signal. It isn't smarter risk to reward ratios. It's a clear-eyed understanding of the maths and a willingness to sit through statistically inevitable pain without intervening. Markets don't owe you consistency. The maths doesn't owe you a streak break. The only thing you can control is whether you're still in the game when the probabilities finally show up.